So we're here inside of Justin Brown's office, representing New Home, of course. Justin's one of my buddies. I've known him for over a decade. By the way, don't let the tattoos fool you. This dude knows what he's talking about. I normally have a collaboration with a bunch of lenders, a bunch of realtors, and Justin is my go-to guy a majority of the time when it comes to a client walking in my office, or a client hitting me up on Yelp, or a client sliding in my DM, so to say, on Instagram or Facebook. Rest assured, I normally vet these different lenders and realtors when it comes to that type of analysis, if you will. So I asked Justin, I said to myself, I said, man, I want to surprise Justin, ask him, hey, some questions on camera, and get his feedback on a couple different things. Because here's a scenario, ladies and gentlemen. I had a client that hit me up on Yelp. She's 71 years old, her husband's 71 years old. And they asked me, they said, Manny, do you believe that I should get a reverse mortgage? And since I don't do loans, but I know enough information to be dangerous, I let her know, well, that scenario is it's not a one-size-fits-all type of scenario. So I asked her a couple questions. I said, what type of income are you currently on? And she said, I'm just on Social Security. I said, okay, you're just on Social Security. Do you have any retirement income? Do you have any annuities? Do you have any type of pension plans? And she said, no, I have no pension plan or no retirement option. I said, okay. Now tell me a little bit about the legacy plan. And normally when I ask what's the legacy plan, clients kind of take a step back and they go, what is that, you know? And so she says, what do you mean by legacy plan? I said, well, once you have all your assets in one bucket, who's going to inherit the assets, and what's the most beneficial tax strategy possible to do so? And she said, we don't have a plan. And I said, well, I think it makes sense that we get together and visit. So those are a bunch of different questions, but in analyzing a reverse mortgage, I wanted to turn the camera to Justin to ask him, hey Justin, what do you think about this scenario? And what specifically can a client look forward to in analyzing that subject matter? So Justin, I'm going to turn it on him. So Justin, if you can you go through a couple bullet points on a reverse mortgage that you would otherwise go through with a proposed client?
Yeah, for sure. So thanks for surprising me and barging in. I wasn't expecting anybody today, but yeah, so a couple important things that we've talked about in the past with reverse mortgages that people need to know is you got to be 62. So there's an age requirement.
There's 62.
62. Okay. And you know, depending on your age, typically at about 62, when you're first eligible for a reverse mortgage, you need equity. You need about 50% equity, right in that range.
50% equity.
50% equity. And then there's also a life expectancy component. So the older you are, 65, 70, 72, that equity component goes down, the requirement's less. So you might get into 60% or 40% equity that you need, 30% equity. That's going to be on the high end.
So there's play.
Yeah.
So correct me if I'm wrong. So if I got a client that's 62 and they want to get a reverse mortgage, they can get one if their value of their house is 50% loan to value. So
right about there.
In that scenario, my client's home, I pulled it up on Zillow just to get a rough estimate of what it looked like. It's about $700,000. So the value of the house at $700,000 right up here. 50% loan to value means that it would be $350,000 loan to the value of the house, right, Jay?
Right about there. Because there's going to be some closing costs and things like that. So if they don't want to pay any money out of pocket to get into this, then a little cushion from there. But right about 50% is the rule of thumb.
Awesome. So what he's explaining, just so you guys understand it, is the older they get. So let's say they start at 62. Or I'll put the bullet point here, they start at 62 and they gradually get older. So let's say they're older, they're at 70, the loan to value now could be 60 or 62%, dependent on the actual strategy that you
correct.
Throw in there, right?
And it's based on you and your spouse's age too. So,
okay.
And your spouse actually doesn't have to be 62 for you to qualify for a reverse mortgage. So it's another conversation and topic there. But yeah, as long as one of you is 62, then it's
what
an
else?
option. So it's not FICO driven. That's a big misconception.
Not FICO driven.
So yeah, it doesn't matter if your credit scores are low, high, if you don't have perfect credit, don't let that deter you from checking into it, because it's still a great option because it's not going to be FICO driven.
Okay.
Options, you have options with a reverse mortgage. So one, the biggest benefit I see is just eliminating the payment. You've worked hard your whole life and you should enjoy retirement, or at least have this option to free up some funds. So you're able to eliminate your payment completely with a reverse mortgage. Two, in some cases, depending on the equity, you're able to do what's called a 10-year payment, where you get paid money every month the rest of your life.
Wow.
We could set it
Similar
up
to an annuity then.
similar to an annuity.
Awesome.
We could do a term on it, like 10 years, 15 years, and if we do a shorter term of payments, the amount will be more, but we could also set it to where it doesn't matter how long you live, you'll always get a fixed guaranteed amount.
Awesome.
There's
So let's put this up here too then. So there's different options, you said,
Yeah.
right? So different options to the reverse mortgage. They could either get cash out, they could get a specific amount of cash out, or they can get a monthly payment. So that's kind of cool.
sometimes a combination of the two also. Get a
Or a
payment
combo.
and have some cash out.
Okay, sweet. And then what he did say that I want you guys to catch on to as well is that you have no more mortgage payment. So in this scenario that I'm talking about, my potential client, her mortgage payment is roughly $2,200. So every single month it puts $2,200 back into their pocket. So just like Justin said, they can retire with some type of dignity. Another challenge that she's having is the pipes are old. It's an older house. The roof is kind of messed up. They have a pool, but the pool has no water in it because all the stuff doesn't work, because they're on a limited amount of income and they just can't afford anything else. Go ahead, bro. I'm sorry.
So this would be an option where they could eliminate their payment and get themselves an emergency fund, or take out some cash to fix up the home. You could have a good amount of cash set aside in an account with a reverse mortgage. It's called a home. It's like a home equity line of credit, but it actually builds interest and gains value. You don't have to use it, but it's there for emergencies. So that's another nice feature that's an option. The one thing though to keep in mind is you do have to pay your taxes and insurance still.
Absolutely.
So you remove the mortgage
have
payment.
to pay your taxes and insurance. Okay.
So you remove the mortgage payment, but that's still something you're going to be responsible for. There is a way to include it in the reverse mortgage, but they basically take your life expectancy times how much all that costs, and that kind of eats away into the cash out and stuff like that. So I don't always recommend it, but it is an option too in there sometimes. You'll never be upside down on your home. That's another misconception, conversation I have with clients is you'll never owe more than what your home is worth. So no matter what happens in the market, if the value tanks, if it grows, you're never going to owe more than what it's worth. There's insurance for you to protect that from ever happening.
Now this is another question that I had of the potential client. She says, well, in this reverse scenario, what if I change my mind 5 years from now? And I'll just ask Justin to answer the question. But if I change my mind 5 years from now and I want to sell the property, is that still an option for the
1,000%. So reverse mortgages are set up to where you should always have a good chunk of equity. That's why they require so much equity up front. It's because they want to make sure no matter what the market fluctuations are and no matter how long you live based on average life expectancy, that you're always going to have a good chunk of equity. Because if you do end up upside down, the bank has to eat that loss. They want to get paid eventually. They don't get paid until the home sells or you refinance. So they want to make sure there's a good cushion of equity in there to make that happen.
Can I ask you one question? Because everything sounds perfect, terrific.
Yeah.
But one question that I have is, God forbid, let's say mom and dad do pass in this scenario. Like, I've heard rumors that the bank is gonna take my house from me, all these different things. If I'm the son that's inheriting the property, do I inherit the property?
Yes. So the property still does what you intended to do. Whatever's in your will and your trust, that's what's going to happen with the ownership of that property. So if you leave it to your children or to family members, they're going to own the property. With the reverse mortgage, they will have to pay it off within about 6 to 12 months though, which is plenty of time. No matter what the value is and no matter what your reverse mortgage balance is, they'll never owe more than 95% of what the home's worth. So that is a worst case catastrophe scenario, like in 2007 when the market crashed. If somebody had a reverse mortgage then, they might have been in a bad spot where they didn't have any equity, but they still never would have been upside down. There was so many Americans that were upside down in their mortgages during 2007. Everybody who had a reverse mortgage didn't have that problem. Yes, you lost equity, everybody lost money, but they were the few that weren't upside down because of the insurance component that's part of it.
So what's the worst, like I've always been taught as a human being, especially here in the United States, and things change, by the way. It's February of 2000, it's almost February of 2020, so it's late January right now, and rules change. So everything that we're saying here could change dependent on the changes in that particular loan program. But everything sounds great. What is the downfall? Because what I've heard from my perspective is the only downfall to this I'll call it perfect scenario is really kids have to pay the debt, right? They inherit the debt.
Yeah, no. Essentially because it has to get paid back. And it's either going to get paid back by the family selling the home or refinancing the home.
Right.
If the family wants nothing to do with it, or there is no family, then they're going to basically foreclose on it after all that happens, just like they would if you stop making a payment and don't do anything. But essentially, no. The family owns the home. You have time to sell it. The only downside I've ever seen is when the kids are expecting something from it, for an inheritance or something to that degree.
Yeah.
That's really it, because it's just like a regular mortgage, except instead of you making payments to the bank, you don't have to. And the balance does come up every month, so the equity goes down, but values increase as well.
And I've had that scenario, ladies and gentlemen that are listening. I had a client come in and it was a viable option. I recommended that she look into it with a reverse mortgage specialist. She wanted me to be present in the appointment to kind of represent her on the financial strategist standpoint. And I did, and guess who was the only one telling her, don't do it? Her daughter. So the one that was going to inherit more debt inside of the program but free up more cash for mom just was not on board. So
it's usually the case.
Yeah, and that is the case. You get, I mean, respectfully, you get the guy that just never had a consistent job growing up, or they have a big inheritance at the end of the rainbow that they've been waiting for. That's normally the only downside to it, is that the inheritor, which is the children, inheriting more debt versus inheriting less debt on the property. And they still got equity inside of the house though, but they want it all paid off.
Yeah, they want as much as they can get. But it's not going to be for everybody. In situations, if you only have 5 years left on your loan or 8 years left on your current mortgage, then it might be better looking at ways to just continue paying it off and just having it completely paid off. But if you're 62, if you're 75, and you have 25 years left on your mortgage, you should be able to enjoy your retirement.
Absolutely.
So that's where it's an option that I think could be a huge breath of fresh air for people.
Now, keep in mind, the questions that I asked in the beginning of the video, you should definitely pay attention to. But on that note, you should be asking yourself, and I'll just write it right up here, is what type of exit strategy do I have inside of my current legacy plan right here? Number 2 question should be, well, if I do give off money to my heirs, there's 2 types of income sources. There's live on money, and then there's leave behind money. So those should be categorized inside of your financial plan to have your financial strategist kind of earmark them for that scenario. And then lastly, of course, which is probably one of the most major, is do I have a living trust that outlines all of these different things? Now, Justin and I don't do living trust, but we can tell you that it is absolutely a necessity in your family's wealth transfer, if you will. So I want to thank Justin for his time. Again, you can find Justin at New Homes. So Justin, you want to give your information?
Yeah, my website's loansbyjd.com. So you can find me there, and or call me 714-494-5322.
Awesome. That's all that we have. Obviously, here at the Financial Architects, we're always moving and shaking. We're here with one of the top lenders in Southern California. But make it a great day, and just know that you're exactly where you've chosen to be. Come visit us. See you.